let's start by reviewing a little bit from section 1-1 and 1-2. So in section 1-1, we talked about the accounting equation, which is ALLO, and I told you it's the most crucial thing to me by far. So assets equals liabilities plus owner's equity. And assets are things that we own, like cash, prepaid insurance, supplies, accounts receivable. And liabilities are things we owe, and accounts payable is the only one we'll have this trimester. And then we have owner's equity, which is the difference between assets and liabilities and is our claim to the assets of the business. Then in section 2, one of the new things we did besides just figuring out how to do transactions is we distinguish between accounts payable and accounts receivable. So the word on account is what's going to alert us that one of these is involved. And I have to figure out which one it is. So if it's payable, I know it's because I bought on account and was going to pay for that later. And accounts receivable is I sold on account and I'm receiving the cash later. So that is what we have to figure out. And then we talked about on transactions and went through 5 of them, but we said there's 5 steps to evaluating a transaction. I have to identify the accounts affected, and there's always 2 or more. I have to classify what that account is. Is it an asset? Is it a liability? Is it owner's equity? And then I have to decide if the account went up or down in that transaction. And then once I've done that, I am going to compute my new balances for every single account. And then the last step is I'm going to make sure that the left side of the accounting equation is equal to the right side of the accounting equation. And if not, I have to go figure out why. Did I add wrong, subtract wrong, put it in the wrong, up, down, whatever. So that's what we did on the 5 transactions in section 2. And now we're going to work on the remaining transactions in section 3. And the big thing that we need to know before we can do that is that there are lots of things that affect owner's equity. And the account that we have thus far is called capital. So how does that get affected? And there are 4 ways. So the first way that it gets affected is by an investment by the owner. And what that means is the owner contributes their own personal assets to the business. So they give the business cash, they give them land, they give them computers, chairs, furniture, whatever the case may be. Some asset they give to the business. And then it belongs to the business. Okay? But it affects their claim to the assets. They're the ones that gave it personally to the business. It now belongs to the business. The second thing that can happen is the opposite of that. The owner withdraws, D-R-A-W-A-L. And the owner takes out assets for personal use. So they take cash out of the business, they take a computer out of the business to use for their personal purposes. It no longer belongs to the business then, it belongs to the owner again. That is the withdrawal by owner. The reason that I started my own business was to generate some cash so that I could take that cash out of the business so I can travel and do the vacations and things that I like to do, go to sporting events, etc. The third way that capital is affected is through revenue. So revenue is the sale of goods or services. This trips people up a lot, and I'm never quite sure why. If I'm an entrepreneur and I want to start a business, why do I want to do that? I want to sell goods or services to people. That's why Michael Delgado started his business, was so he could sell web services to clients. So that is what we call revenue. And then we have the last one, which is expense. And this one's tricky for people initially too. So that is the cost of goods or services to operate the business. So costs associated with advertising, costs associated with hiring people and paying them, costs associated with paying taxes to different government entities, costs for paying the bank for having an account, costs for actually buying the merchandise that you're going to sell down the road. That is my cost of operating the business. The phone lines, the electricity, the utilities, etc. It is not the same as a liability, which is something we owe. When we have a cost, regardless of whether we pay for it immediately or we pay later, the liability, it's still a cost. My advertising is advertising, and I've incurred that cost to operate the business, no matter if I pay them with cash right away or I pay down the road with an accounts payable. So those are the four things. So I have to know whether or not those make capital go up or down. So does it make my right as an owner better or worse? So the two good things, we want it to go up, we want more of a claim, is investment by owner and revenue. When the investment is given by an owner, it's better for the business. They have more assets, which gives the owner a claim. And when I sell things, I have more assets, cash or receivable, which is a good thing. And then the opposite is true of the other two. Down and down for this, or decrease, increase, whatever you want to say. But expenses, costs of doing business, that's not a great thing for a business. We don't like expenses. So it makes capital go down, and that claim by the owner is going to go down. So keep this kind of cheat sheet from your notes near you when you start to do these next transactions that we're going to do, because we're going to have to specify which of these four things happened and what the effect on capital was. So if we go to the student page, if you recall, we were, let me fix that real quick, we were at this balance right after transaction 5, so $835 in cash, $2,000 in capital. That's where we left off, and we had this new transaction now, which is that we received cash from sales on the 10th of January for $1,100. So we're going to go through that same 5-step process. So what accounts are affected? So the words received cash tell me that cash was affected. And if cash was affected, I know that it was going up. It's an asset going up because I received it. The business got money, so it went up. Then I would look at accounts receivable. Was that affected? I don't see anywhere here where it says on account, so it is not accounts receivable. We're not receiving later. It's not supplies. I don't see supplies. I don't see prepaid insurance anywhere in that transaction. I don't see any words that say on account, so it's not accounts payable. So it has to be owner's equity. It has to be capital. The account is capital, the classification owner's equity. And it has to be going up so we stay equal on both sides. So it's going up. Why is it going up? It's because it's revenue. I've sold something. Sales is revenue on your little cheat sheet. So you know that sales revenue is a good thing. It makes capital go up. So then the last step I'll do is calculate the new balances and make sure that I'm still equal. So if I add the left side, I get 3,220. And if I add the right side, I get 3,220, and I'm still equal. So then I go to transaction number 7. And it is on January 12th. And I sold services on account to Main Street, $500. So rather than going account by account, well, I can do it on this one. I maybe won't on some of the later ones. So did anything happen to cash? I don't see anywhere where it says cash. I didn't receive cash or pay cash. So nothing happened to it. accounts receivable. Do I see where it says on account anywhere? Yes, it says I sold services on account. On account to Main Street Services. So that tells me, on account tells me it's accounts receivable. And is it going up or down? It's an asset. Is it going up or down? So I had no receivable from these people. Now I've sold them something. They owe me money. I'm going to receive more down the road. So it made it go up. So that is a plus 500. Nothing happened to supplies. Nothing happened to insurance. Nothing happened to accounts payable. It was account receivable. So none of those are affected. And again, I know that both sides have to equal, so I know that I'm at a plus 500 under capital, and the reason is because of revenue. The words sold services tells me it's revenue. The word sales up here told me it was revenue. So get used to finding these keywords. Sold services, revenue. Revenue, a good thing for capital, went up 500. Calculate the new balances. And again, keep pausing when you need to write this stuff in your notes. And the new balance on capital is 3,600. And if I add this right-hand side, I get 3,720, and over here I have 3,720. Next transaction, January the 12th. Paid cash for communications bill for cell phone and internet service. So the words paid cash tell me that cash was affected. Cash is an asset. It is an asset going down because I paid it. So it is going down $80. Nothing happening to accounts receivable. Nothing happening to supplies. Nothing happening to insurance. Nothing happened on account that I'm paying later. So it has to be capital. And for capital, it has to be going down, so it's either a withdrawal or an expense. Well, the owner didn't do anything, so it's an expense. It's a cost of the business. What's the cost? It's a communications bill or a phone bill or internet is the name of the expense. So expenses are bad. Expenses make capital go down. Then I calculate my new balance. And when I've done that, you see what I got. I obviously did not update for capital. So the new balance of capital is 3,520. Add the amounts on the right here to make sure I still have left side equal to right side. And I get 3,640. And over on this side, I get 3,640. And if anyone wants to verify that's true on their calculator, please do, because God knows I could screw up the adding and subtracting, but I don't think I did. Okay, the next transaction, January the 13th, we paid cash for equipment rental. Same old, same old. We see the words paid cash. We know cash, which is an asset, is affected. It is going down because we paid cash. Nothing's happening to accounts receivable. Nothing's happening to supplies. Nothing's happening to prepaid insurance. Nothing's happening to owing someone on account. So it has to be a negative again on capital, and it's not a withdrawal by the owner, so it has to be an expense, a cost of business, equipment rental. It's rental expense, so going down 400. Calculate my new balances. When I do that, these are what I get. I'll make sure my right side equals 3,240, and my right side, or my left, sorry, is the same, 3,240. I'm still equal, so I am in good shape. And I go on to my next transaction.